Hi, I'm Jared Nelson, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week, we are going to look at another fundamental concept of investing and trading, valuation. Valuation is a measure of how much something is worth, but in the markets, valuation doesn't just consider the worth of an item today, it also considers the value of that item in the future as well. In finance, items of value are known as assets or investments, and these investments are valued based on their expected future returns. So, for example, if you own property and you rent it out on a 5 or 10-year lease, you will have an income stream from the rent that you receive over that term. By comparing the rental income to the purchase price of the property, you can work out the yield or return that it will generate for you. However, we can take that calculation one stage further and work out what that future cash flow is worth today to create a valuation for that property or asset. In the financial markets, professional investors and traders do something similar to value investments and assets, such as stocks and bonds, using what is known as the Capital Asset Pricing Model, or CAPM. The math behind the CAPM can get quite complicated, but the model aims to work out what the expected rate of return for a given asset should be. That calculation is based on factors such as the risk-free rate of return, for example, the yield on the 10-year U.S. Treasury bond. More specifically, the asset's beta, or sensitivity to a change in the price of its underlying sector, and the time value of money. Here we are talking about interest rates and opportunity costs. When those values are run through the model, we end up with a number that is the expected return on our asset, which will be expressed as a percentage. By comparing that figure to the risk-free rate and to the expected rate of return of other assets, we can build a picture of where that asset sits in the grand scheme of things, as well as its valuation. And perhaps more important than that, what its valuation should be. Now, a little bit more theory. The price of an asset and its valuation are two separate things. The valuation is what the asset is worth. Its price is what an investor is prepared to pay for it. Investors are usually prepared to pay more to own assets that offer higher expected rates of return. In the case of stocks, one measure of those expected future returns is a company's earning per share. By comparing those earnings, or EPS, to the company's share price, we can determine what's known as the PE, or the price-to-earning ratio. That ratio tells us what multiple investors are prepared to pay to own that stock or stream of earnings. If a stock is on a PE of 10, it means investors are prepared to pay 10 times its earnings to own it. However, if a second stock is on a PE of 25, then investors are prepared to pay 2.5 times as much to own the second stock than they are the first. By calculating the PE ratio for all stocks in this way, we can create a valuation framework, within which we can directly compare the price and valuation of stocks and identify those stocks which look cheap with a low PE ratio compared to their peers. Or alternatively, those that look expensive or have a high PE ratio compared to the wider group. The investor's job is to try and determine whether those relative valuations and prices are correct. Investors will look to buy stocks which they believe are valued too low and sell stocks which are overvalued. But what happens when a company doesn't make a profit and therefore doesn't have any earnings? How can we value those businesses? To do that, investors look at other metrics, such as how fast a business is growing its sales and market share, its cash flows and gross revenues, as well as the costs of doing business. These are used to predict what those businesses will be worth in the future. This approach is often used to put a valuation on tech companies. Critics argue that valuing companies that don't make a profit, and may not do so for years, in this way is a mistake, and that investors should not be chasing the share prices of those companies higher. As we can see from this chart, which plots the Goldman Sachs Nonprofit Technology Index, those warnings seem to be falling on deaf ears. Shares in those companies have risen fourfold on average in less than 2 years. Ultimately, of course, it's for the market to determine whether those valuations are justified, but remember that the market is just an expression of the collective opinions of all investors, large and small. According to Trackstar IQ, our proprietary search tracking tool, we can see huge institutional focus on high-growth equities, many of which are trading on vast PE multiples, or are pre-revenue but growing rapidly. This suggests that for now, the market is able to rationalize these valuations. That's all we have time for this week. To find out more about our Trackstar IQ data, sign up to our free newsletter at investingchannel.com/Trackstar. Remember, make sure you do your own due diligence before making any investment decisions.